Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor. I'm really pleased to have with me once again Axel Merk. He's the president and CIO of Merk Investments, manager of the Merk Funds, which he founded in Switzerland way back in 1994, and then moved to California thereafter. Welcome, Axel. It's good to have you with me again.
Good to have you. Good to be with you. I'm as Californian as it gets these days. Even my accent is almost Californian.
No, not quite. Not quite. You can't take, and I wouldn't want you to lose your Swiss accent, Axel, because I think that makes you charming, and also I think makes you distinct. So you don't want to be just like all the other American fascists. You want to be a distinctly unique, a distinct, unique human being, which you are, and we thank God for that. So, your new fund, the Ounce, O-U-N-Z is a symbol. It's a very unique ETF in which you not only buy gold, but you can take possession of it. How is that going?
Oh, very nicely. I mean, other gold ETFs have been losing gold, and we've been gaining gold, and so that's obviously very nice to see. It's a gold ETF. It trades like the other gold ETFs, with a key difference that investors can take delivery of their gold. They can take delivery of the London bars, or if they choose to do so, when they take delivery, they can have it converted into coins. And by the way, taking delivery in itself is not a taxable event. You're just taking delivery of what you already own underneath. So if you have shares that are appreciated, like to take possession of the physical, you can do so. With the other ETFs, you'd have to sell them, potentially pay taxes, and then only sell gold with the proceeds.
No, so it's quite a difference and a very unique product, and I want to thank you for putting that together. Taking possession is something that seems to be more popular now. I mean, I'm guessing, and I want to get your comments on what we're seeing, the lease rates for gold. I was just mentioning it. I looked at Kitco, and the 1 month lease rate is distinctly higher than the 3 month and 6 month lease rates, and only about 7 basis points away from the 1 year lease rate. Do you make anything of that?
Well,
I think that's important.
The short-term go-for rates are negative, and that means, yes, some supply is tight. And obviously, I mean, you've discussed it many times, there's a disconnect between the paper and the physical market, and some people say it's conspiracy. I think that conspiracy, if it is one, happens in every single market. It's just in gold. We point it out all the time. When gold goes up for 12 years in a row, as it did, well, sure enough, some people take out leverage. And so the deleveraging, as it unfolds, will then provide a disconnect between the physical demand and the folks that need to sell out. And so this is unfortunately how markets work. They tend to be irrational longer than people stay solvent, and the gold market is no different. Investing is supposed to be frustrating from that point of view.
Yeah, if it was easy, everybody would be rich, and obviously that can't be the case. But so where are we going to see a second year in a row with a lower gold price, or do you think we can see a positive number before the year is over?
Well, that's a good question. Of course, we don't try to have a crystal ball for the
future. Yes.
What I do know, I can tell you why we buy gold and why we put this product together in the first place. Well, we put it together because people were wondering how we hold our gold in the past, and then we did a search, and this is what we came up with. We decided we need our own product. But more importantly, what people I don't think realize is that real interest rates are actually significantly negative.
Yes.
Interest rates minus inflation, if you believe the CPI, if it's not more inflation than that. In fact, if we have a very hawkish Federal Reserve, at the end of 2015, some of the most hawkish views say a federal funds rate would be at 175. That means we would still have negative real interest rates, at least in our assessments. And if you do a long-term projection, if you go out 10 years, I don't think we can afford positive real interest rates. The worst thing that can happen to the globe is to have good economic growth, because then we would have bond prices fall, and financing our deficit, in my view, is going to be extremely difficult. We might pay $1 trillion more a year just to service our interest expense if we extrapolate from the numbers of the Congressional Budget Office and apply the historic cost we've been paying our interest. And of course, The Europeans have a similar issue, and the Japanese do just as much. And that sort of environment, to me, is supportive for gold in the long run.
Axel, what do you make of Japan coming in with an enormous stimulation right as the U.S. is announcing, the Fed is announcing the cessation of quantitative easing?
Well, the Japanese are pretty much saying, let's move our assets abroad. They are more than doubling their allocation to foreign equities. They are also adding substantially the allocation of foreign bonds. They're basically moving their $1.2 trillion pension fund, move it abroad. They're debasing then the currency. In my view, it's not going to have a good ending for the currency, in the hope that at some point they can repatriate some of that at significantly better values. Having said that, of course, the Japanese population is aging. Over time, there will be net sellers of foreign stocks. And by the way, they've only announced this program. Stock prices in Japan have already gone up. So by the time they start buying those foreign stocks in the springtime, they'll already be elevated. So Abenomics, in my view, is going to be a recipe to accelerate the demise of the yen. And it's not going to have a pretty ending because Japan is much bigger than Cyprus is.
Oh, yeah, I guess quite a bit bigger. Well, it seems to be a tragedy, really, in economic terms, if growth is a bad thing, if a growing economy, a booming economy is a bad thing because interest rates go up. I mean, it's a testimony, I think, to the really bad economic policies and monetary policies that have been engaged in. You mentioned the yen. I should just mention to our listeners that you also have several funds. You have 4 different funds, but I think at least one of those invests in currencies. Isn't that the case?
Yes, we actually have 4 different currency funds, and just to close the loop on the one before, don't worry, I don't think interest rates are actually going to go up that high, at least not initially, because central banks are going to keep rates low, because how can we possibly have high rates? So central banks will keep those rates low. Of course, something is going to give. It is going to be the currency, and yes, as you point out, we do manage currency funds. We have 2 strategies in a nutshell, if we have a better printing press than the rest of the world, and 2 strategies if you think they're currency wars and you've got to be more tactical and be a step ahead of the game. The reason we have those, by the way, is because we think in this environment it's ever more difficult to diversify, because when the printing presses work, everything goes up in value, but where on earth do you hide when things turn the other way? And of course, gold is one way to do it. You can try to do it with currencies as well. You have some advantages and some disadvantages, but yep, that's the space we're in.
Yeah. Well, I just have to ask you, a newsletter that came across my desk today was suggesting, and they showed a chart of the gold price going back to 1975, and it showed the parabolic rise from $35 to $850, and then we went into like a long 20-year bear market in gold. Now we've had a bull market, as you point out, 10 years in a row. We've had a bull market. Gold has risen in price. And this chart is looking ominously like the chart did in the 1982-83 time frame. And they're raising the question, what if it's 1982 all over again? Do you think that's possible?
Well, I think if we had Paul Volcker come into the Federal Reserve and institute his policies, we'd have a revolution. We simply cannot afford the sort of policies he put in place at the time because we have so much more leverage in the economy. And in fact, one of the things that's been happening, every time the Fed is trying to do an exit, just go up a little bit, just to raise expectations of going up, let alone go to 20%. We have the stock market have a fit, and the reason that is the case is that we've based this recovery on asset price inflation, and as rates go up, asset prices have to go down. And the reason they have to go down, at least in our assessment, is that the one thing central banks have achieved is they have compressed risk premium, meaning that risky assets don't appear risky anymore, be that junk bonds, be that the stock market. And if we do have an exit at the Fed, well, risk premium have to expand. The VIX index, the volatility index of the S&P, should go up again, and everything else equal, stock prices should come down. And when you base a recovery on asset price inflation, that's very harmful. So we cannot have the policies we had in the early 80s, because the moment the Fed sneezes, the moment the Federal Reserve says we might have an exit, we have an unwinding of all this wonderful stimulus we've had, with all the bad for the economy that comes with it, and that's why they're having a fit whenever the market acts up just a little bit.
Well, so then this thing can go on forever. We can keep printing money forever. We can keep creating money. As someone's pointed out, the Fed never runs out of money. It can always create more. Other banks can always create more. But the point is, we're not seeing growth in the real economy. You said the worst thing that could happen is we'd have growth in the real economy. But when does this sort of fantasy game, this paper game that's played with money created out of nothing, when does it intersect with reality, that is economic reality? when does this thing, how far can it go? When will it break down?
Well, economic reality is already impacted. I mean, you used to think this is only money we're talking about, but monetary policy is driving the wealth distribution in the world. When you have ultra-low policies and your hedge fund managers, you can deal with it. If you're mom and pop saver, you can't, or you get hooked on credit and you fall through the cracks when you hit a crisis. And so the wealth gap is increasing to these policies. Real wages haven't gone anywhere because of the policies we've had. People get upset. Here they vote for a more populist politician. So you see the rise of the Occupy Wall Street movement and the Tea Party. In the Middle East you have revolutions. In Japan you have Abenomics. Well, what do you think is happening in Ukraine? They can't balance their books. That's their problem. That's the key problem that they have, and now they want money from the West rather than from the East. So it's already having an impact. Now the currency side of things is just one element of it, but the one thing you can be sure of, policymakers throughout the world have in common, they never blame themselves. They blame minorities, they blame the wealthy, they blame foreigners, and so you can see less political stability, and at the same time, we kick the can down the road, and with that, we erode the purchasing power of currencies. This can take various twists and turns, and we can only hope it's going to play out peacefully.
Well, we have had quite getting back to gold, we've had quite a correction here, I guess you would say, but I get your point, Axel. I understand why you believe that we're not going to see 1982 again in the gold markets simply because things are a lot different than they were at that point in time. The United States, I think at that time, might have still been a net exporter or just had ceased being that. We had a much stronger still manufacturing economy to a much greater extent than we have now. We were producing things other than bombs that we could export around the world. So you recently, though, spoke. Go ahead. You had a thought?
Yeah. Yes. Well, the biggest threat to gold, which is basically a brick that doesn't pay any interest, is positive real interest rates. So if you tell me we're going to have an extended period of positive real interest rates, then we have a threat to the price of gold. I just don't see that. In the U.S., it's the first time in history that both consumers and the government have, in my view, too much debt. Foreigners own that debt, so we have an incentive to debase the value of the debt. It's not in the interest of the government in the U.S., in Europe, or Japan to keep that value high of their currency. And so that is why I'm saying we're not going to have a repeat of the early 80s.
Well, you recently I think you had met up with Alan Greenspan, and he had some things to say about gold. And he's not telling most people that he talks to about this, but as I understand it, Mr. Greenspan is quite bullish on gold.
Well, he said a bunch of things. One of the things said that you cannot not have a gold standard in a welfare state, and it's up to you to decide whether we're a welfare state or not, but we've certainly increased our entitlement obligations. He was then specifically asked about where the price of gold will be, and he kind of fudged it and says, I don't want to do a short-term forecast. And then he said, well, in 5 years he thinks that it will be higher. How much? He said measurably. So obviously that doesn't tell you too much, but in his speech or in his Q&A, he kind of piled in on things. He said the Fed's balance sheet is a pile of tinder. That's a quote that has to be lit, and inflation will eventually have to rise. And so again, kind of we're lucky that we don't have economic growth, because if we do have economic growth, we have a boatload of challenges. And then a few days later, Greenspan said that he thinks there has to be turmoil as the Fed has an exit. He was asked whether he would use the word crisis, and he kind of grinned and he said he'd rather use the word turmoil.
Yeah, well, yeah, I guess. And you can't see a crisis, you can't see a bubble until after it's burst anyway, he says. So,
and he says you can only have if you want to pop a bubble, you can only do it if you want to risk a severe recession, and he was never willing to do that. So at least he's frank about that.
Well, at least his follower, his predecessor, certainly did pop one.
Yes.
And it was a doozy, and I don't think he meant to, but it happened in any event. So I think beyond a government's control, we could always have the risk of a credit implosion again, couldn't we, Axel?
Well, certainly. I mean, we've driven this economy to more credit-driven society, and that's precisely why it is so difficult to raise rates. That we're just putting things to a halt if we start raising interest rates, and that's going to be the tough one. Now, clearly, some other things might be boosting economic growth, but ultimately, the debt hasn't gone away. Currently, government debt the current deficits are a little bit lower, but the pile is just piling up on the entitlements, and we are just better at pushing the can down the road than others are, but ultimately we have as much an interest to debase the value of our debt as the Japanese do.
We have just a couple of minutes left, Axel, but with your Swiss background, I do have to ask you about the Swiss Gold Initiative. We talked to Ron Paul on this show a week or two ago about that, and another guest, a Swiss citizen as well. But tell our listeners, what is the Swiss Gold Referendum that's coming up? What is it about? What are the main points?
Well, I mean, strictly speaking, the key points is that on November 30th, the Swiss will be voting that, and if it passes the vote, that the Swiss National Bank may never sell any gold again, must repatriate all its gold to Switzerland, and must hold at least 20% of its gold 20% of its reserves in gold, and these are kind of in combination. So whenever the price of gold were to dip, they might have to buy additional gold, and they could never sell it again. And basically, the Swiss people, I mean, the background to this is that the Swiss National Bank has printed as a percentage of its balance sheet almost as money as the Fed or the Bank of England, and people are upset. They're upset that the currency is pegged to the euro, or at least has this one-sided peg to the euro, and so they're saying you've got to do something about it. The government is pushing back and saying it reduces our flexibility, and the proponents say, well, that's kind of the point, right? I mean, you shouldn't be doing that with our savings. And at this stage, the odds of that initiative passing are fairly low, unfortunately. At least that's my assessment after having listened to some of the debates in Switzerland. But at the same time, it's a wonderful point of discussion to raise that awareness, and I hope other countries are raising similar issues so that one can have these debates.
Well, I think some other countries are, not necessarily countries that are all that positive towards the United States, but, Russia and China and some people like that. Just one final quick question for you. Last Friday, I think it was, after gold took a nice run higher, the boys on Fast Money on CNBC were talking about Russia possibly backing the ruble with gold, and one of the panel members there said if Russia backs its ruble with gold, it will have the strongest currency in the world. And another member of the panel got really upset by that. He said, "You must be drinking something. You must be smoking something, my friend. How could you say that?" And, if you were sitting on that panel, how would you have answered that? How would you have responded?
Well, all these discussions are, I think, theoretical. A gold standard will only hold if a government is willing to balance its books. And Russia clearly cannot do that right now. And anybody who believes in the gold standard, wants to have a personal gold standard, should have their personal gold standard and not wait for the government to embrace it.
Good advice.
Governments are just prone to spending more money because they want to win elections. And so it makes for good rhetoric, and if somebody introduces it, great. But don't trust it to last. Most countries, or all countries, have given it up again that ever had it. And that doesn't mean it's a bad thing, but it means that these promises that are made are usually not kept.
Yeah, discipline, and people don't like that too much. We're really out of time, Axel. It goes so fast, but I want to mention merkinvestments.com. Merk, M-E-R-K, investments.com is the place to go to follow Axel's work. And I guess you send out a missive people can sign up for, right, Axel?
Sure, we got a free newsletter. I'm on Twitter. Follow me on Twitter. And, yes, have a look at our funds and look at our gold ETF.
Very good. Very good advice. And I must say that I have purchased shares of that ETF, OUNZ. It's where I keep my that part of my investment portfolio in gold. Again, the uniqueness about that is that you can actually take the physical possession of that gold, and it very, very closely mirrors the price of gold as well. So it's you buy 1,000 shares of ounce, and you've got 100 ounces, 10 ounces of gold, I guess it is. Thank you very much, Axel, for being with us again. It's really great talking to you. I look forward to doing it again sometime in the near future.
My pleasure.